We need to use this time to think. We're not going back. But where are we going? What do we want for our planet, our communities, our future? If we don't answer this question, it will be answered for us and blame shifted from the powerful to the powerless. We need each other now. We need to reflect and reset, strategize, organize, assemble, collective power. This is a network. Join, claim the future. Hello, can I welcome everybody to tonight's discussion. A few weeks ago, there was a great deal of publicity around the meeting of the G7 finance ministers and the quite extensive positive coverage about the discussion that they were having about how to tackle tax avoidance and tax evasion by multinationals and bringing in an attempt to bring in a new global tax regime. It received an awful lot of coverage, and I think it raised a large number of people's hopes purely and simply because for the first time in a long while, we were getting world leaders potentially looking at the whole issue of corporate tax avoidance. But there are clearly, when the detail of the scheme emerged, there were clearly some concerns about how effective this new regime would be in really achieving tax justice and whether the multinational corporations would be paying their way, how much would be raised, but also who would be the real beneficiaries of it. So we thought what we'd do tonight is just bring together for a discussion three of our experts who've been working with us over a period of time on taxation and banking and other financial matters. Let me just introduce the people who'll be talking tonight. The first is Prem Sikka. Many of you will know is the professor of accountancy. Now has been, I take some responsibility for this, been forced into the House of Lords to raise these issues on our behalf, trying to ensure that, again, financial services are properly scrutinized, but also government policy in relation to taxation as well. Our other participant is John Christensen, all of you will know from the Tax Justice Network, who's been working over the decades to, first of all, expose what's happening in terms of our tax regimes, but also to propose alternatives, and has been an analyst of this latest deal to see whether it really is the significant advance that some people thought it would be. And our third panelist is Professor Daniela Gabor. Daniela specializes in analysis of banking and shadow banking in particular, and has been helping us throughout the years in terms of developing policies in which we can tackle some of the issues that are presented by the finance sector and how we harness banks and finances for the good, for the long term, and also particularly in relation to tackling some of the issues around inequality and climate change. So this is going to be an open discussion, and if there are any questions that people have or points they can make, please put them in the chat and we'll address them as we discuss them over the next hour. And there's no other way of doing this other than picking on someone to start the conversation off. So Prem, do you want to give us your views on, first of all, the outline of the G7 tax deal, but also your views on how successful it will be in tackling these issues of corporate taxation and corporate tax avoidance and evasion? Prem, are you with us? Oh, I think we're having some problems in terms of the connection. Classic. Okay. John, can I turn to you until we get Prem back?
Yeah, sure. Look, is this a game changer? And my view is certainly not. This is not the game changer we hoped it might have been. I mean, I remember in early April, I was thrilled when I heard US Treasury Secretary Janet Yellen, she was commenting about the race to the bottom. And I've been working on the race to the bottom for years and years. And she was recognizing how harmful it was, this race to the global economy, and even self-defeating as far as the US economy is concerned. And it's worth recalling what she says. So I'm going to quote what she said. By choosing to compete on taxes, we've neglected to compete on the skill of our workers and the strength of our infrastructure. It's a self-defeating competition, and neither President Biden nor I are interested in participating in it anymore. We want to change the game. Now, when I heard that, I was, of course, thrilled, because I've been arguing along these lines for decades. And alongside that comment, the president announced that he would be reversing his predecessor Trump's cut to the corporate income tax. Trump cut it from 35% to 21%, and Biden planned to raise the rate to 28%. So this seemed in early April to be an historic moment. After 40 years of racing to the bottom, the world's most powerful economy was announcing that it planned to step out of the race and start over in an entirely new direction. So we were full of hope in early April, and I remember talking to radio stations around the world saying this is a game changer. But the G7 announcements can only be described as weak, with only a handful of countries likely to come out better off, and many countries in the global south potentially going to come out very much worse off. And John, one surefire signal that the G7 proposals aren't the game changer that we might have hoped for is that the immediate response from Wall Street was a rally on the stock markets, with some tech stocks rising by 2% or more. So if Wall Street analysts aren't quaking in their boots, then we must assume that the plan simply lack ambition, and for certain the 15% proposed minimum corporate tax rate is far, far lower than the 21% rate flagged up in early April, and way lower than the 35% minimum rate I've been calling for since forever. And just for listeners who kind of might think that 35% is way over the top, it's worth recalling that in 1980, the average corporate income tax rate in the G7 countries was slightly over 50%, and the UK rate was 52%. And now the average G7 rate is slightly over 25%, and the UK rate is 19%. So not the game changer we might have been looking for, John.
Just go through some of the detail of the deal itself. There's the corporate tax rate, 15%, down from 21% that even Biden was arguing for. Who's going to gain out of this deal at the moment? Which companies, well, first of all, will it capture multinational corporations in the way that many first reported? And then secondly, what sort of scale are we talking about? How much are we talking about? Either would be caught under this scheme or should be if we had a decent scheme. But then also, which countries are going to benefit from this?
Yeah. That's the big question. Which countries are going to benefit from it? Some countries could actually be undermined by this. So, for example, we've been picking up on right-wing politicians in the Nordic countries, which, of course, generally speaking, have higher rates and, importantly, fewer reliefs and quite strong tax authorities. Given the scale of operation there, they are still able to maintain reasonably powerful tax authorities. And the right-wingers in the Nordic countries are saying that this 15% minimum rate will become the target rate. And if that's the case, then some countries in the Nordic region, and I have to say countries in the global south, particularly in Africa, are likely to lose out because the race to the bottom will continue. As I said earlier, John, my view is that the 15% rate is far too low. 21% was modest. 35%, frankly, would be ambitious, but something to target. Now, as far as which companies are likely to gain from this, I think, many companies, of course, are paying an effective tax rate in single figures, so some of them might well end up paying more. But the question is, where will they end up paying more? And kind of my estimation is that most of them will end up paying more in the United States, but they might actually end up paying less in other countries. So this deal, particularly as far as high-tech companies are concerned, is likely to yield quite significant extra revenue for the United States, which is exactly what Biden had in mind. But I think other countries will lose out as a result of this. But one thing I think we need to kind of factor into our consideration is, will the G7 actually have the political power to push this through? Because G7 has been, their star has been fading for well over a decade now, and political power is shifting to G20 and to the so-called inclusive framework countries that have been brought into these discussions by the OECD. So I think we really need to pay attention to what's going to happen when the G20 meets later this year to discuss these proposals, because both China and India have been signaling that they want to stop the political race to the bottom, but let's face it, both of them have been using special enterprise zones for many, many years. So that they will want to be part of the discussion, and they'll be wanting to be net gainers from this. And the concern that I have is that there will be a limited number of net gainers, United States, possibly some European countries. I don't think United Kingdom will gain from this, and I think that there will be quite a number of net losers from this proposal.
You mentioned enterprise zones. The government's introducing free ports. I'll come back to you on that one, because again, there's been hardly any debate realistically, either in Parliament or elsewhere, on all of that. The Prem, welcome back. Your connection went down, and the pictures we were getting of you were almost impressionist, in terms of fuzziness. But I've just been asking John the question, really, whilst you were out of the room, of who gains, how much are we talking about, and whether these proposals will really work. When I was first interviewed on them, the first interview I had was a journalist putting it to me, well, all that you've been arguing for the last number of years, you've been vindicated, haven't you? At least they're now talking about tackling tax avoidance and tax evasion at the global scale. They're talking about country by country reporting and trying to prevent the shifting of profits, etc. But as John has said, they might well be talking about it. It's quite a difference between talking and delivering. And so far, the delivery has actually been, well, I suppose paucity, yes, but in some ways, by not delivering from these discussions, we're losing an opportunity maybe for a generation. Prem, what's your view?
Well, I think the positive thing is at least they are talking about curbing the destructive tax competition, which is, one aspect. And when you look at the Pillar 1 and 2 developments, in many ways they've been pushed in, they've been promoted by countries outside the G7. They pressurized the OECD into developing that kind of a framework. We have to remember that the OECD's BEPS project, which has been issuing statements since about 2015, in many ways was endorsing a failed system revolving around arm's length principle, which is transfer pricing. And in their previous statements, it did not really demolish that. But I think it is after that, with TJN and many others were telling them, look, that isn't going to resolve the problems. And they sort of move forward. Just to, in case people are wondering what the problems were, there were three main problems with there still are three main problems, if you like, with the system for taxing multinational corporations. And these problems arise from an agreement or a series of treaties secured from the time of the League of Nations onwards. So it's over a century old. The idea was generally that companies would be taxed at the place of their residence rather than where the economic activity took place. Now that suited Western nations incredibly well, because when most of the world was colonized by the Western powers, they were very happy to tax companies in other countries by just pretending that they were controlled from London. That happened to De Beers, for example, which had the diamond mines in South Africa, but old Cecil Rhodes had some influence from London, so it had to be taxed in London. And the other main issue was this principle of separate entities. So the idea was if a company had 100 subsidiaries, it would have 100 taxable persons. Therefore, you had a recipe for profit shifting and playing tax games. And therefore, the nation states agreed that they would work out some kind of a price for the input of the goods and services. But the difficulty is in a modern world, we can't find arm's length independent prices because the assumption is you've got many buyers and sellers. Nobody's a price maker, everybody's a price taker, but that simply isn't so. We just have 10 companies at the moment which control about 60% of the world's pharmaceuticals trade. So the idea that you can get an independent price is very difficult. 67% of the world trade in seeds and fertilizers and around the same for biotechnology is controlled by 10 companies. So you can't really easily get independent arm's length prices. But the OECD stuck to those kind of principles in its previous BEPS statements. It had to be pushed for a change. And then it came up with the Pillar 1 and 2 development, and it issued it issued consultation papers last year. And it is out of those consultation papers that what we now heard from the G7 governments, which the announcement came up. So basically, Pillar 1 deals with the allocation of taxing rights between jurisdictions and considers proposals for allocating profits on a new basis. And that is the formula earlier, which John may have referred to. If not, I'll come back to that. And then the idea is, how do you deal with tax competition? Well, that is where the minimum rate comes in. My reading of the agreement is it does not really nullify issues about tax avoidance, because those transfer pricing games can still be played. Companies can still shift around profits, though this idea of a minimum tax rate may cancel out some of the benefits, but they can still really play those games. And the other thing is, what this agreement does is only captures generally large companies with a turnover of more than 750 million euros. And you can see how the finance industry, extractive industries, already operating closely with the OECD, they managed to persuade the OECD that they are special cases and therefore they ought to be excluded. Now, that does not mean nation states have agreed that they ought to be excluded. So it is interesting where Rishi Sunak picks up that cue and says they should be excluded. OECD said that there were some peculiar aspects of them which needed to be considered. But how those peculiar aspects are considered is still open to debate. So what we are talking about is 750 million euros as a threshold, but that itself is problematical. Firstly, companies can move in and out of that grouping. So what do? Do you say 1 year something is caught by this Pillar 1 and 2, but the next year it isn't? So that creates a kind of a definitional problem. The other is, how do you arrive at the tax base? Now, I'm quite horrified, and Richard Murphy and I wrote a paper about this some time ago, that they are willing to go along with accounting numbers at the OECD. Now, the accounting number problem is that the state is not setting it. It is groups, it is really private entities like the International Accounting Standards Board, dominated by the big four accounting firms and big companies, which is setting the accounting rules. Of course, tax purposes, you can override some. But what the OECD paper was suggesting last year, that we can run along with international accounting standards, or what they call the United States GAAP, that is generally acceptable accounting principles or practices. To me, that is a no-no. That is really an invitation to allow everybody to play the games. We already see that how at BHS, Carillion and others, management have discretion. They will choose accounting numbers which suit them, but nobody else. So the whole thing about the calculation of the tax base needs to be rethought. And ultimately, my view is that only Parliament then has the right to define the tax base, not some private enterprise group. And in this case, International Accounting Standards Board, which defines the UK accounting rules, it is an offshoot of a company, a foundation, holed up in Delaware because of secrecy. Now, are we really going to allow an entity which is an offshoot of a Delaware entity to define our tax base? And the answer to that is really utterly undesirable. Now, the other thing about G7 is it does not constrain a nation state from setting its own corporate tax rates. They can set it at any rate they want, okay? But then, there are the Pillar 1 and 2 provisos. So some part of a company's profit can be taxed locally. That is a 20% margin above the 10%. But is that really the full story? I sort of doubt it. I think at the end there are more questions left than answers with this particular agreement. And we will no doubt in the coming months and days hear more about it. But as John said, countries outside the G7 need to sign up. So I think we have next month, or is it next month, the G20 ministers meeting. They would consider this. The early analysis from organizations like TaxWatch would suggest that UK would probably lose because it's going to cancel its digital services tax. You can't do that if you're signing up to the G7 agreement, and on that basis it would lose some. But I think developing countries stand to gain a lot. I was speaking to some economists from India, and he said they would probably gain about 10 to 12 billion dollars a year on the basis of the Pillar 1 and Pillar 2, because they are having a hell of a job constraining some multinationals, and no doubt other countries would do too. So that is just sort of my openers, as it were, to invite some comments and discussion later on.
Thanks, Prem. I'll come back to what I'd like us to do, that we can critique the G7 proposals that we know. But as you say, they are actually discussing it, which is a breakthrough in itself.
That's right.
We've got it on the agenda. But I want to come back to you all in a minute about, well, what would we want? What is the ideal proposals that we'd put forward? Daniela, what's your comments on the process so far of the discussions and the debate that has taken place from the G7? And also, how has that actually started a wider debate now about the whole realm of international finance?
Thank you. At the risk of, trying not to repeat what the previous speakers have said, although I'm very intrigued by Prem's suggestion that it would benefit some developing countries and low-income countries. Let me just summarize my understanding of where we are now, and maybe give some ideas of what would be desirable to ask for in order to make this, because what we need to bear in mind, I think, is that there is a political process going on, a negotiation, which may keep this as a Trojan horse for a much more sort of lax tax regime that we have now, or it could become a much tighter tax regime, a true change in the way in which we tax not only corporations but also very rich high net worth individuals. So I would say there are three problems with this. It's not high enough. What we have on the table for now, it's not high enough. 15% is quite low. Plus the Pillar 1 sums that Prem brought in. I would be interested to read more about that, because my understanding is that it won't generate a lot of revenues for countries in the global south in particular. For example, the African Tax Action Forum has complained and voiced concerns that this will deprive African countries, well, on the other hand, of investment. But we know this is a narrative that says, well, you know, the narrative of the race to the bottom is you need lower taxes in order to attract capital. But there is also concern about the ways in which this might actually concentrate tax revenues into high income countries, particularly the US. So not high enough, not redistributive enough, and this is something that we need to discuss more, who benefits in terms of actual tax revenue for countries. And my concern, where I'm coming from studying the world of international finance, is that I think it's not broad enough, in the sense that this is basically focusing on trying to reduce the ability of multinational corporations to use tax havens or to pay very low corporate taxes or almost zero corporate taxes. But it's not the kind of change in the tax regime that we would want in order to remove some of the sources of let's say, pressure in the shadow banking world that we have had so far, that comes from the very fact that we are not able, or we have not been able for the past 30 to 40 years, to tax high net worth individuals, to tax private equity firms, to tax the kind of entities active in global finance that are very good at doing or taking advantage of the tax regimes and cross-border tax arbitrage. And I think this matters very much, and I want us to think not only in terms of fairness. I think it's very, very important to bear in mind the first argument that people react to is if I, as a university lecturer, am paying progressively up to 50% tax on my wages, then it probably is fair for multinational corporations and billionaires to pay something every year, right? And I don't know if you've seen the data on US billionaires. I pay more taxes, or a university professor in the US pays more taxes than in some years than, I don't know, Elon Musk or the private equity bosses. So there is an element of fairness, and I think for us progressive is important, but there is also an element that I think matters in terms of macro finance, this idea of why does it matter, or what are the spillovers from our inability to tax global finance properly. And we know that the conservative government is trying to carve out exemptions for the city, precisely because it views it as something that needs to be protected. And I'm sure that if they manage to do that for the UK, then this will be sort of agreed at a global level. So we end up with a situation where some of the most important and richest sources of instability in the shadow banking world don't get taxed, right? And why does this matter? Because if we think very carefully, who are the actors in the shadow banking world that we have heard about and are behind some of the causal mechanisms that gave us the Lehman Brothers crisis and instability since then? It's not, just hedge funds going around and doing speculative bets, but it's also high net worth individuals and multinational corporations who, because they don't pay tax, are sitting on large pools of capital or cash, and they need to place them somewhere, and they give them to private equity companies, they give them to hedge funds in order to invest on their behalf. So this is a sort of two-way game, in the sense that the inability of the state to raise taxes or to tax adequately both multinational corporations and very rich individuals is not only depriving the state of important tax revenue that can be used for the provision of public goods, but it's also accelerating the pressure to privatize these public goods, to sell them off to private equity companies, for example. And you can think about housing in London, you can think about student accommodation, you can think about social care. If you want the landscape now, if you read, I do this, I've done this for the last couple of months, I've been reading the investment projects of private equity companies from the US, and they're all saying we are sitting on large pools of capital. Can we find assets, investable assets in Europe? Can governments please stop investing in housing? And because we are ready to do that. We are ready to provide housing. And of course, once you use it, where private equity companies are investing and how they are basically financializing public good provision, then you're able to connect the questions of taxation to broader questions of the kind of state and the kind of society that we want to create in the provision of public goods. And I'll stop here.
No, let me just tease that out a bit more though from you. The whole issue at the moment that we're facing with regard to climate change and the threat of that and the key role of the state, the same argument is now being put with regard to private equity and greenwashing, effectively, of how climate change can be tackled by the private sector and by private equity. That's exactly what's happening, isn't it?
Yes, I mean, private equity is offering governments very, very plausible narratives of how their ability to raise huge pools of capital, particularly from this kind of tax arbitrage or tax avoidance mechanisms. They will not say this publicly, but obviously this is a large part of their financing comes, or their capital comes from this type of sources. They are selling this narrative to governments that they can contribute to the climate challenge by basically investing in green assets, that they can contribute to the housing crisis by generating or investing in housing. And it's a convenient narrative for governments who don't want to address the political question of a better taxation regime. And it's also a convenient narrative for private equity, because greenwashing is a very nice source of profits.
Exactly. John, can I come back to you then? Given that critique of the G7 finance ministers' proposals, given the fact there is some doubt about how much of this will fly in terms of the G20, nevertheless, they've opened up an opportunity to have the debate more widely conveyed and understood, as long as we get our act together in being clear about the critique, but also being clear about the alternatives. Where do we go from here then in the promotion of those alternatives? And a lot of this is about having a very straightforward narrative of exactly what's wrong, and then also relatively simple measures that could be put in place, or at least lay the foundations of a system that's more effective in ensuring the proper distribution of the proper distribution of the responsibilities of taxation.
Yeah, it's a great question. Look, one of the really positives, that's the big positives that's come out of the discussion so far, going back to what Janet Yellen said, and remember that, this is a toweringly important economist saying this, is that tax competition is actually counterproductive. It undermines development. And the Chancellor, Rishi Sunak, actually, in his own way, confirmed that tax competition has not been attracting to this country the kind of investment this country needs. And in fact, it does the exact opposite. In my opinion, we should look at the investment data over the last 30, 40 years. Too much of the inward flow of investment is actually focusing on, yes, privatized industries, but buying up at kind of rock bottom prices, privatized industries, mergers and acquisitions, real estate acquisition, and a whole load of what I would think of as rent-seeking investments, rather than new, innovative, productive activities which create jobs. And I think this country kind of serves as a horrible warning to the rest of the world of how tax competition doesn't actually yield the kind of results that people claim for it. So one of the areas where I think progressives now need to focus the discussion is on this whole issue of, if not tax competition, what should we be doing? We should be reversing out of it, and we should be reversing also out of regulatory competition, because that's equally harmful. So what are the alternatives? Well, quite clearly, this country and countries around the world need to invest massively in better infrastructure, in better training, and in research and development. We need to kind of rebuild that kind of Keynesian focus on creating a productive economy. That's the starting point. And getting the tax framework correct for that is absolutely crucial as far as I'm concerned, because the tax framework is currently geared very much towards the interests of the big rent-seeking, not just private equity, but big rent-seeking multinational companies who have been calmly and steadily monopolizing or creating monopolistic structures right the way across this economy, across Europe and elsewhere. And I think one of the most interesting discussions that's going on alongside this has been the emerging discussion in the United States about completely revising antitrust policy in order to tackle the big players and push back against their political power. And we need to have a similar discussion going on here in the United Kingdom and in Europe. And I'm part of a very interesting new initiative called the Balanced Economy Project, which is trying to pick up on what's happening in the United States around antitrust policy, and build a similar, contribute to a similar conversation here. Now, I just want to pick up on something that Prem said, because whilst I agree that India, with its very strong tax authority and frankly its very strong political engagement with G20, it might well end up as a beneficiary. I think that other developing countries are likely to lose out, and that's because the current proposals focus entirely upon sales. In other words, where sales actually occur, and that tends to bias towards Europe, North America, and the richer economies. And there's a bias against developing countries, particularly in the south, in Africa, where, yes, they might have quite a large number of big players, the big multinational companies, mining and extracting and whatever in Africa, but the sales are not so high. So I think these countries are likely to lose out. And I think that's a reason for saying that actually, if we move towards a formulary apportionment approach to taxing multinational companies, the formula needs also to take account of how much labor is employed and needs to not just focus on sales, but also on labor engaged. And that, I think, would be of greater benefit to the developing countries. But also, I think that we need to recognize that the days of free ports and special enterprise zones are long since over. I was frankly dismayed when the current UK government started talking about kind of revisiting the free port argument. Free ports were not successful in the 1980s. They certainly were, and were removed, not that long ago. So why are we going back to this discussion about free ports? We need to push back strongly against free ports. It seems to me that this undermines not just the tax base, but also the tax, the terms and conditions of employment for people who actually work in free ports, and creates kind of mini tax havens and mini regulatory havens, which will undermine worker protection and consumer protections elsewhere in the economy. I also think that we need to be talking about, because John, you asked what should we be doing? We should be pushing it back against this kind of de minimis threshold, where only companies above 750 million euro actually fall into this bracket. I think that's far, far too high. Yes, I can understand the reasons for targeting the big 100 or so companies under Pillar 1 arrangements, but I think that we need to be pushing for a much wider, a lower threshold and a much wider range of companies to be included in this, and absolutely no exclusions for the City of London. I mean, it's typical of tax haven thinking that the first thing that the City of London does is say we need to be excluded from these arrangements. Like heck you do. You should be absolutely included in the arrangements, and no exclusions whatsoever. So there's some thoughts to add to the discussion.
The reason I raise free ports is because it's before Parliament at the moment. And like you, maybe I'm getting too long in the tooth, but it was like watching a car crash repeat itself, because I can remember the enterprise zones, and I can remember George Osborne's advocacy, and I can also remember the Public Accounts Committee report, where we found that actually there was no significant increase in employment, but what employment was increased was actually low paid and low skilled.
Absolutely.
And at the same time, when they've operated these Freeport Enterprise Zone initiatives, they suck jobs from outside the rest of the region and into that particular geographical area. I can't find anywhere where it's been of benefit to the wider community, but significantly has been benefits of a large number of fly-by-night companies who are here today, gone tomorrow, having exploited them. But it is quite remarkable that here we have a chancellor who was glowing referred to in some of the media for promoting some of the debate at the G7 around tackling tax avoidance and tax evasion, and yet at the same time promoting free ports, which seemed to fly in the face of everything that was being discussed. But it certainly was ironic. I'm hoping that, well, the bill is before Parliament at the moment. I've spoken against it. We'll be moving amendments to the legislation because it's going to be difficult to defeat overall. But I just think we're going down another cul-de-sac and it will cost taxpayers a large amount of money, as the enterprise zones did as well, for little local benefit for local communities. Prem, let me come back to you. Where do we go from here? Tell us what you've outlined, the critique and some of the issues here. I want to come back to the point that you made about some of the poorer countries benefiting, because again, that's partly contested. But also, can we just have a clarity about the principles of what a system would look like that will stand the test of time? First of all, one of the issues we've raised is if we are going for some form of minimum corporation tax of some sort, everyone has agreed the 15%, to be frank, is a bit of a laugh, isn't it? It's a bit of a joke. We know that. 21% we thought was already too low. And what I find is interesting in discussions with people, most of them will say, well, actually, I pay maybe twice that amount if I earn my income through my own labor. And there's an injustice there. That's the first thing. The second thing is about, obviously, this issue around how do you assess what should be paid in an individual country. John has raised this issue about, of course, it's about how much profit they make and how you disaggregate that. It's also about how much employment is there. There's another issue that some people have raised with me as well, which is actually it's also about where some of the natural resources of the world are drawn from that contribute towards that company's profits as well. As you've seen, we saw that in mining operations, but also we've seen it in other extractive areas where in the developing world, exploitation of natural resources, as well as some labor, have taken place. And again, how do you therefore calculate that element of where those profits, where that taxation should be levied effectively? Prem, over to you on this one.
Well, thank you, John. I think let's just kind of remind ourselves what the G7 agreement was about. It totally excluded from Pillar 1, the OECD paper on Pillar 1 excluded finance, business, and mining. Now, and when you look at mining, that includes oil, gas, and other natural resources industries. So therefore, that is working against the interest of countries, especially in Africa, who won the nature's lottery but can't collect the final winnings because companies simply don't book the profits there. So when you look on the US list of the largest companies, 37 of the top 100 companies in the US are finance and insurance companies. We live in the era of finance capitalism. And they form, and when you look at the top 200 companies, they're still about 37%. So you can see what the US is actually pushing for. It is really protecting the major industries, and the countries which won't really be able perhaps to benefit that much would be the ones which have the natural resources. But I think what countries like India are doing are trying to interpret this agreement in a way which they think they can tweak, as it were, to benefit, and hence the assumption. Now, 15% just been mentioned. 15% itself was floated by the US Treasury in a paper in April 2021, which is called the Made in America Tax Plan, which said that the US corporate tax rate should be 28%, and then there should be a 15% minimum tax on, and this is the important phrase, on book income of large companies. Book income, which means it's all your accounting profits, okay? Because clearly, if we are, I mean, the related issue to this agreement is, even when they talk about 15% minimum tax rate, somebody has to say 15% of what?
Yeah.
If it is your accounting profit, well, that is like playing with a bar of soap. You know, you're just not going to be able to pin it down. And whereas what developing countries, I think, are seeking is wanting to pin it down, which then means, in a sense, you've got to pay attention to the tax base. So far, the attention is to the tax rate. I agree with John Christensen earlier when he said we really need to think about a formulary apportionment. But again, apportionment formula applied to what? So the OECD work, which underpins the G7 agreement, talks about at least some kind of apportionment to this 20% margin above the 10%, but it's not really they're not really taking account of everything, things like where the employees are, where the assets might be, where the sales might be. At the moment, that is relatively undecided. But that is where the detail is going to be. And I keep wondering at what point the EU would be pushing its version of the unitary taxation to say, look, that offers a way of negating all intra-group transactions, because then you would really be taking the global profit of a company like Google, and then by using a formula, allocating it to each country depending on where the sales are, where the employees are, where the other activity is, which might give us a better answer. And my recollection is that there was some modeling done on that at TJN, John, I'm sure, would recall, which suggested that under that, developing countries would gain and the tax havens would be the biggest losers. But I think the other problem is, the likes of Amazon saying that they have margin of less than 10% they would escape, I think there is a counter to that, because Amazon's global margin, some people have looked at its accounts, and they think its global margin may well be about 30%. So that means it's going to then play games about how it is shifting, because the tax base under the G7 agreement is essentially based on arm's length pricing system within an accounting framework. So that means they will have plenty of opportunities, but they haven't really come up with an answer to that as to how they're going to deal with the tax base number. So that, I think, would remain a sticking point for quite some time. And what Richard Murphy and I and others had proposed, that you really need a long-term project talking about accounting numbers for tax purposes. So just to give people a feel, at the moment we have many books of accounts. One set of books tells management what's going on, and that's called management accounts. One book tells the external world what's going on, and that is called financial reporting. One book tells the taxman what is going on, and that is tax purposes. Then there's another set which tells regulators something else. So we have many, many different kind of, as it were, approaches to accounting numbers, and they overlap, they conflict, they undermine. The net result today is that for financial reporting purposes, companies come up with the highest possible profit because that impacts on executive remuneration and profit-related bonuses. Then they concoct the same for tax purposes and come up with the lowest possible number because they don't want to pay tax, because tax in conventional financial reporting is treated as an expense and therefore results in a lower profit. So they are playing all these games, but these games are not getting attention. Some of us have said sometime, if companies really believe that the results they publish in their annual accounts are true, then let's use them for tax purposes. You will soon see them depress those profit numbers, because they would say we don't want to pay. I don't buy the argument made by neoliberals that you shouldn't really tax companies because somehow if you do, that would depress wages or the shareholders are bearing the tax burden. That is ridiculous. Companies like Starbucks have not been paying tax, but we haven't seen the employees' wages triple, have we? The corporate tax rate came down from 52% to 19%. Employees' wages have stagnated. So that sort of debunks that. The idea that all you're doing is taxing shareholders, no, we are not. Shareholders are not the owners of companies. They never have been. There is no economic theory. There's no legal theory which says the shareholders are the owners. They may have controlling rights, but that's a different issue. And besides, companies are a legal person in their own right. They are busy creating deadly diseases, whether they relate to adulteration of food or tobacco or thalidomide and other things. And somebody has to clean up the environmental mess as well. So therefore, we need companies to pay. And we can't create exceptions for the mining industry and the finance industry. But what I was the point I was making earlier was that these entities have got into the OECD. If you ever attend an OECD committee, you will find these are the entities already in, and they are impressing their case. It is the ordinary taxpayers who are left out. And the other sad thing is, John, that in the past, UK and other governments have accepted the OECD rules, and there's never really been any parliamentary debate about it. John and I stumbled across to some meetings in Geneva of these and UN committees, and then you find, these corporate entities are there framing the rules, and then they're not discussed at Parliament. It is simply accepted that that is the last word. And I think, again, in Parliament, we have to find some kind of ways of challenging this. But I do feel for poorer countries, I think under the EU model, they would do better than under the G7 model. But there's a long way to go yet.
Thanks for that, Prem. Just as an aside, in Parliament, I have to say, over the last, about a month ago, when government ministers got up for the first time in a decade to tell us that they no longer believe cutting corporation taxes increased employment. And I'd had that rammed down my throat by at least 3 successive chancellors, Tory chancellors. I thought it was a bit rich after all of that, to be honest. But there you are. I'm a great believer in the powers of conversion at times. Final question for you. I've been trying to throw questions to you that people have raised with me. Final question before we go off, and it's Lucy Fyson has asked it. So let me read it to you. She said, I find it hard to get people excited about the huge importance of pushing for tax justice. Do the panel have any ideas for how to engage people, voters, who find economics daunting and inaccessible? Can I just, before I ask all 3 of you, can I just say to Lucy, I can remember, I'm sure Prem and John can, when UK Uncut turned up, a group of young people who took tax justice seriously and started demonstrating and occupying the buildings of those companies that weren't paying their taxes. And suddenly tax justice did rise to the top of the agenda in terms of some of the media and even in Parliament for a period of time. So actually, you can excite people and they can be effective. What do you think, John?
Yeah, I was there with the UK Uncut People, but only a few weeks earlier, I'd been speaking to Stephen Timms. Of course, at the time he was in the Treasury, and he was saying to me, John, until such time as we have people on the streets demanding country by country reporting, ain't nothing much going to happen. And then we had, the takeover of Vodafone and Topshop, and I got a lovely photograph of me and my sons. I'm standing there with a high-vis jacket with economic advisor written on the back, and great events. And hats off to the activists for recognizing the importance of taking to the streets. But I think my answer to the question, which I think is a profoundly important question, is, I mean, we need tools to help people get into it. And one of the things I worked on was a film called The Spider's Web, which is available on YouTube. And I think The Spider's Web has helped. I mean, millions of people have watched it. And it's helped an awful lot of people to understand the issues, but also to understand the importance of the issues. So there's a starting point. Perhaps organise a screening with your friends and discuss some of the matters raised by The Spider's Web. They will see Prem Sikka being profoundly rude about various people in that film, and it's
completely out of character.
Completely out of character.
Prem, how do we excite people to, as John has said, to campaign on this? Because actually, when the campaigning takes place, it does work to a large extent in raising the issue.
I think it's a really, as John said, a profound question, also very difficult, because you have to, in a sense, connect dots and persuade people. It seems to me we need musicians to make songs about these things. We need playwrights to write plays. We need leaflets. We need documentaries, like John said, The Spider's Web. We need street corner meetings, neighborhood meetings, because behind all this is issues about social justice, as John has said. Tax revenues affect people's pensions, they affect access to welfare services, the National Health Service. The National Health Service has plenty of other things going on. And our whole, access to the social world depends on tax revenues and how we care for each other. So I think these kind of dots need to be connected. This thing, John said, I was being rude. I don't know what he was thinking about. There was I have a feeling John has in mind, which is in the documentary. There was this meeting at a place, and it was me versus a Price Waterhouse partner, and I talked about how they are basically robbing the public purse through tax avoidance schemes, and how they are basically like mafia, hence the phrase I've been using, pinstripe mafia, for a long time, that they are basically disabling people. And he, at the end of the meeting, the convener said, okay, just to sum it up, and this guy turned on me. He said, Professor Sikka, what's wrong with you? We must be doing something right. We have thousands of satisfied clients and we make a lot of money as well. And that was it. And he sat down, and the chair just looked at me and said, your turn to reply now. And my immediate reply was, making a lot of money, lots of satisfied clients. That's the language of pimps and drug pushers. That is not how you judge whether something is socially desirable or good. There are other yardsticks which have to be used. And I'm afraid when we finish, he refused to shake my hand. I think he would have gone for my throat, but he refused to shake my hand. So that's how it finished. I don't know if that's what John's thinking about. I think, in a sense, these people think that their profit is the only thing that counts. And that is, really the worrying thing about it. We have to challenge that kind of a narrative. Instead of their profit or anybody's profit, we have to think about what is good for society as a whole. Because actually, with our society as a whole, even these firms can't flourish, because we provide healthcare for their employees, we provide pension, we provide a transport system, we provide security, we provide all these things that they take for granted. And that is the narrative we have to challenge. And these firms are now busy lobbying the OECD and others for more exemptions for their clients. They're already probably busy about how to undermine the framework which G7 have announced already. I'm sure they're doing it, and that is what we are up against.
We talk about corporate capture in theoretical terms rather than the reality of the physically how it's done. And it certainly is, and will certainly happen in this country. Final point on that, though, Daniela, if I can come to you. We need a debate around shadow banking, don't we? As alongside this taxation debate, because so little is understood about shadow banking and what mechanisms we need to start putting in place, both to raise awareness, but also to have some form of accountability in this field.
Yes, thank you. I thought listening to Prem that maybe we also need a debate on sex work, but maybe not in this space.
Don't worry, we've
sex work is work where I come from, but the films are a different question. And
no, exactly. I would just. Well, that is just on that point. That's exactly why we've supported sex workers throughout. The last thing any sex worker would want to be, they'd feel insulted by us being associated with some of these finance.
I refer to pimps. I didn't refer to sex workers.
That's fair enough. Go on, Daniela.
Yes, I would say just to respond to Lucy, because I think Lucy's question is very important, and it also combined with yours, John. It is, I think, in many ways more challenging to try to engage people on questions that have to do with financial capitalism. And Prem is very right there that we live in an age of financial capitalism, and that matters a lot, not just in terms of the high finance and the things we don't see and the way in which billionaires become very rich and have their interest protected and their profit-making protected. But also the important thing to me about living in financial capitalism is that rentiers or financial capitalists are becoming increasingly important in our day-to-day life, in the provision of what used to be public goods. And I think this is where at least the beginning of efforts to start to debate and to politicize this issue should be. And I have to say that as a teacher, because I'm a teacher in a university, I think the height of our success to mobilize on a large scale debates around how do we want to organize the state, how do we want to organize its taxation and spending abilities, has been when you, John, were in charge of the shadow treasury. To me, the lesson is that you have to occupy a political party to do that very successfully. Otherwise, from the fringes, you might be able to mobilize support one way or another, or do it at grassroots level, but in terms of articulating also a vision of why it is important to think not only in what happens in local communities, but how we need to reimagine the state, and why this is critical to reimagine the state. Because if we don't reimagine the state, then the state will be captured by corporate and private finance interests. And yeah, that's my lesson. So I don't know how to go from this lesson to recapturing the party.
Well, the next thing, just to say, Lucy has actually come back, bless her, and said, I'm a filmmaker and at your service is needed. So yeah, people are contributing their talents in every way. Thanks, Lucy, for that. Just a final point then, to take it up on the point that Daniela made there. All the discussion we've had this evening is, I really need to remind people who may be listening to us that actually all of this was covered in the work that we did in the development of the last two manifestos. And on the advice of Daniela and Prem and John and others, we developed quite a comprehensive set of policies that would address at least the first stages of dealing with these issues. And I can remember the range of publications, but I can remember the tax transparency set of literally was a detailed policy program that we were ready to implement within the first Queen's speech when we went into government. So one of the ways of influencing the agenda is through, as Daniela said, through political parties. I'm obviously a member of the Labour Party. The Labour Party is now undertaking its policy review. What we want to do through Claim the Future and other organisations as well is make sure that we can shape that policy review so that we build upon the foundations of the work that the three of you have done, because I think there's no other way now than in terms of how we can harness the resources of our economy and the global economy if we're going to tackle climate change. There's no other way than having a fair taxation system which is based upon the fair distribution of wealth and power. So that's the importance of this debate. Can I thank the three of you? I'm really grateful. It's been an interesting conversation. And I'm sorry for throwing all these questions at you, but I thought it was important at this time there's some clarity around the G7 deal as we move towards the G20 discussions. And the lesson for me really is, I think it is making sure that we connect these discussions with activities, well, it is back on the streets, I think, to a certain extent, as well as through political debate and political parties. I think it is about exciting people in terms of building a social movement around and rebuilding it around the tax justice issue. Thanks all three of you, and I hope people have found that interesting. Thank you very much.
Thank you. Good night.
We need to use this time to think. We're not going back. But where are we going? What do we want for our planet, our communities, our future? If we don't answer this question, it will be answered for us and blame shifted from the powerful to the powerless. We need each other now. We need to reflect and reset, strategize, organize, assemble, collective power. This is a network. Join, claim the future.